Good afternoon, everyone. Thank you for tuning in today. I am Tanya Tang, Director of Membership and Programming for CFA Society San Francisco. It is my pleasure to welcome you to our webinar today, Public Pension Fund Trends and Fundamentals, Understanding Where We Are. A quick item to note before we start. You will be muted for the event, so we encourage you to type questions in the Q&A box. We will monitor the questions closely and endeavor to have many answered as possible. This event will also be recorded and we will share the replay. Now, I'd like to introduce today's moderator, Dr. Matthew Faulkner, CFA. Dr. Faulkner is the finance professor at Lucas College and Graduate School at San Jose State University, and he is also a trustee for the City of San Jose Pension Fund. Welcome, Dr. Faulkner.
Thank you, Tanya. Very much appreciated. And I know we're all happy to be here and excited to talk about this topic that the CFA Institute and the Society of San Francisco hasn't had much traction on. So I'd like to welcome our guests. First off, we have Jay Kwon, Eileen Neill, and Oliver Giesecke. I'll take a moment to let you introduce yourselves before we get into the questions. So Eileen, could you just briefly introduce yourself and share your involvement with pension plans?
Sure, and thank you, Dr. Faulkner. I am a career pension consultant, so I've spent 30 plus years in this industry, really focusing on large, mostly state level public pension funds, although I've also worked with county and municipal plans, as well as private pension plans and on a national scale. And so in that long career, I've helped clients navigate through the dot-com and the credit crisis and the GFC. My primary role as a pension consultant is to help clients stay focused on their long-term policy objectives and really to provide education to the decision makers as fiduciaries that they are, through really emphasizing investment theory as a basis for decision making and also helping to steer clear of what I would categorize as behavioral induced decisions.
Amazing. Well, thank you for being here and looking forward to all the insights you're going to bring. Dr. Giesecke, could you introduce yourself next and share some insights of your involvement with pension plans?
Thanks, Dr. Faulkner. So I'm a research fellow at the Hoover Institution, and my work focuses on the balance sheet of state and local governments more holistically. Public pensions are a very important component. In fact, on the aggregate, they are the largest liability, surpassing even municipal debt securities in the market.
Perfect. Perfect. Jay, could you go ahead and introduce yourself?
Yeah, sure. Hello, my name is Jay. I've worked at a public pension plan here in the Bay Area for about 10 years. Before that, I did another 10 at an asset manager helping people like me now. So in addition to my day job on staff at the pension, I am a trustee at a neighboring pension system. And just to reiterate, any and all comments I'm making here today are my own and not on behalf of either entity there.
Great. Thank you, Jay. So help me understand this. Let me make sure I understand it and you all could clarify. So a public pension plan typically exists where people are going to work for a government entity in some capacity. We all like to retire one day and we'd like to have some income coming in from that retirement. So throughout the life of my career at a government entity, I contribute some of my paycheck will go to help fund that retirement process, as well as the government will also contribute to fund that retirement. And it'll go to a team like what Jay does, and they work on investing that portfolio so that when I retire, I get my benefits for being able to afford to live the rest of my life. So anything else I should know? Oliver, I know you might have a point to bring up about just the different types of contribution plans. So could you clarify that for me?
Yeah, absolutely. I think what you described is actually already a pretty good definition of a defined benefit plan. Here you said, the employer as well as yourself invest money. And really the important thing is that the employer does it on the employee's behalf. That is, the employer invests in an asset. And the idea is really that at the point when the employee starts to retire, there are enough assets set aside that are financing the benefits that the employee promised, the employer promised. So that's sort of the interesting thing is here that really the employer is responsible to do the investment and also carries the investment risk. That means like if the market underperforms relative to the assumptions, that means the employer has to step in. Similarly, for longevity, we may outlive the assumption that the actuary makes. In that case, once again, the employer steps in and carries that risk. In contrast, there are defined contribution plans in which, once again, the employee and the employer makes contributions. But the important difference here is that they are making these contributions to an investment account that, for the most part, the employee controls. So that means the employee can choose his or her preferred asset allocation, and really the ultimate benefit, the payment that you receive during retirement depends on how much has been contributed in total, but also what was the investment return that the fund achieved during that time. And just to end that with maybe an interesting statistic across the United States, it turns out that in the private sector, about 60% of workers are enrolled in a defined benefit plan, whereas in the public sector, this number is close to 86%. There's really this big discrepancy, and I think the main reason for that result is that the private sector moved away from defined benefit plans somewhere in the 70s and 80s, versus the public sector has remained that model as the primary vehicle to provide retirement benefits.
Perfect. Oh, that helps a lot. So thank you very much for that clarification on defined benefit, defined contribution, and the landscape of pension funds. So let me turn to Eileen here. If you have a comment, you've had this awesome career working with institutional money and pension funds for a long time. And what is one either major change you've seen through your career that you found interesting, or even a broad perspective of the landscape and how it's changed?
Sure. With respect to public pension funds, just focusing on that, I would say over my career, it's changed tremendously. Early in my career, investments were largely in public markets, stocks, U.S. stocks, and investment grade bonds, with maybe a smattering of some non-U.S., again, public equities and private real estate. And today, the sophistication level is just really high for public pension plans. The asset classes are extremely diverse. There's probably close to or between 30 and 40% in private markets and alternatives now. Fixed income really comprises a small percentage, maybe anywhere between 10, 15%. And I think importantly, public pension plans have embraced the concept of accepting higher illiquidity risk and even leverage in order to achieve the types of expected returns that they need in order to meet the pension fund obligations, which are the benefit payments to the plan beneficiaries once they enter retirement. So a huge evolution has taken place over the 30 plus years that I've been in this industry. And I think one of the most positive parts of this evolution is the fact that I think plans really are focusing on the long term and increasingly ignoring sort of that day-to-day noise. For example, during COVID, when the markets really sold off and the world was a scary place, pension plans, by and large, on the public side, really stuck to their knitting and stayed with their long-term objectives unless, you know, there was a rebalancing opportunity that they felt they could take advantage of.
Great, thank you. Yeah, very interesting and nice insights in terms of discussing. We'll get even deeper into this, but in terms of investment strategies and the time horizons. So, Jay, let me turn to you. Any major change you've seen in your career as a senior investment manager, or around the entire career, the landscape of pension funds?
Oh, yeah, you know, to echo Eileen, I think the universe of strategies available to pension plans is changing all the time. And that's a function of the kind of investable opportunity set, right? If you think about, you know, what was a security a couple decades ago compared to, you know, what's an investable security now, it's vastly different, right? Super complicated, maybe increasingly sophisticated every day. You might ask if you're reading, you know, the FT or the Wall Street Journal, you know, what's not private credit these days? It's you have certain spaces just kind of growing over time and kind of taking more and more of the kind of investment dollars available. And so for staff at a pension fund, you're competing against, you know, you're competing against the very fancily dressed Wall Street types out there, more than eager to either take the investment opportunity ahead of you or charge you a lot of money to invest on your behalf. And so, you know, as the world gets more complex, pension plans and their, you know, their employees have had to get increasingly sophisticated to live and deal in that world, right? We have high return hurdles, as Eileen noted. And, you know, plans have had to get increasingly complex. And so you just need to be equipped with more, you know, more tools. And that might be a certification like the CFA. And so it's just a lot of education.
Great, thank you. And Oliver, I'll turn to you. Do you have anything to add to the discussion on major changes or landscapes that you've seen from your research perspective around pension funds?
Yeah, let me maybe give a sort of a more macro or public finance perspective on that, since, you know, I'm looking more sort of from a high level perspective on the public pension landscape. So there was an interesting reform in accounting standards in 2014, and really all the statements that I'm making are sort of related between for the period between 2014 and now, because that's really when we can start comparing things carefully. So it's really quite interesting to see that, you know, the long sort of shadow that the great financial crisis cast on pension funds, and actually like funding ratios, for instance, started continued dropping until about 2016, dropping to as low as 67% on a reported basis. On a market basis would be probably even lower. And then really afterwards there was sort of a I guess like almost like a consensus that might be like a financial resiliency issue going forward. And there was you know, across the United States really a big effort to essentially increase contribution rates, in particular to address the unfunded pension liability. And then, you know, we entered COVID-19, and you know, after all, revenues, I think, held up pretty strongly, even often surpassing relative to expectations. And in addition, we got like about $1 trillion in federal aid to state and local governments. And there we really saw like big contribution in not just like ongoing contributions, but really extraordinary contributions to pension funds. So for instance, the state of Connecticut made it close to $8 billion in an additional extraordinary contributions out of their budgetary surplus. Another sort of interesting trend that I observed, and that I had like active sort of discussions with stakeholders, is a trend towards legislative funding mandates that essentially require that the pension fund has to be fully funded, at least on an actuarial basis, within the next 20, 25, 30 years. And, you know, this is really a sort of a double-edged sword, because on the one hand side, obviously, you improve the financial resiliency of those funds, and you get sort of in a position where, arguably the mechanics of a defined benefit plan is sort of obeyed. But on the other hand side, it really leads to large amortization payments. And at the state level, I think there's somewhat manageable, and there's, I think, a little bit more discretion in terms of the payment profile. But if you're like a municipality and you're facing like a amortization payment that is close to like 30-40% of your discretionary revenues, that almost pushes you to the brink of bankruptcy. And so there have been like a lot of adjustments, a lot of negotiations in order to sort of overcome these initial cliffs when these amortization payments start to ramp up.
Great. Thank you all for those comments on this broad picture. And I feel like I like the diversity of from the research perspective at the broad level, the consulting, and from working in the investments of a pension plan. So thank you for that. Let's move on to start with Eileen here on this question. So you've been a consultant, you've seen a lot of public pension funds at work, and obviously not to any specific one, but generalizably, like, what are the determinants to the pension fund decision-making that you're seeing, whether that be from the strategy or implementation perspective?
Sure. So I think it's important to understand that pension fund trustees and staff are fiduciaries. So fiduciary simply is someone that is responsible for making financial decisions on behalf of another, in this case, participants, a pension plan participants. And so there is a very high standard of care and prudence that's applied to being a fiduciary. And so the most important variable that determines whether fiduciaries are successful or not is really the governance of that entity, of that fund. And from my perspective, I put a lot of credence in, if you're familiar with John Carver's principles for successful decision-making by boards and fiduciaries. The main principle is that the board should focus, as the named fiduciary for the fund, on the strategy. So developing the strategy. And that really simply is setting the asset allocation policy, as well as the risk budget and the benchmarks. Those are the strategic decisions that the board as fiduciary makes. And that and these strategic decisions really drive the majority of that pension fund's return and risk experience. And studies have shown it's at least 90% of a pension fund's return and risk experience is driven by that very key decision of setting the asset allocation policy. So the board really has to have a laser focus on that and be revisiting it regularly to ensure that the policy that they select is the right policy to achieve that particular fund's investment objectives. And then in terms of implementation, which is simply the execution of the board's policy, again, sort of deferring to the John Carver's principles, that is really best delegated to staff and board consultants, because that really is the day-to-day activities then that ensure that the board's strategy and objectives are being fulfilled. And in terms of that staff, then it's important for the board to ensure that the staff is comprised of competent, experienced investment professionals that are capable of making the right implementation decisions. So implementation decisions are, structuring the asset classes the boards have selected and selecting the investment managers that are hired to manage the assets. And in a lot of cases, there are funds with internal management where the staff is managing assets, maybe alongside external asset managers. So And then that staff needs to be resourced appropriately, again, to make those effective implementation decisions. So resources would be perhaps utilization of specialty consultants, or having analytics that they can use and databases that they can access. And so, that would be considered a prudent decision, is to use some of those fund assets to appropriately fund those resources necessary to support implementation. So that all goes back to governance, ensuring the right governance is in place, and that you've got the right decision makers with defined roles and responsibilities, board, staff, and consultants and other vendors. Each know their role, and that everyone is working together to ultimately achieve those strategic objectives set by the board.
Great. Thank you for lots of that insight. I know that pension fund decision making is certainly not taken lightheartedly. So, any other follow-up comments, Oliver, Jay, to that specific question before I move on?
Yeah, I think that was a great answer, really, and kind of all of the nuances that Eileen gave in her answer kind of show that there's a lot of different ways to solve that problem, right? There's a lot of, if you look across the universe of public plans, even within kind of plans of the same size, they're not structured all exactly the same. They have different governance models, different investment programs, and I think the key, as Eileen noted, is to have an alignment across the organization. Right? If you're going to run the plan a certain way, if you want to run it that way, you have to properly resource it. And you have to make sure that, the staff has what they need, that the trustees understand their responsibilities, and, have things kind of all lined up. Otherwise, you have a machine that doesn't really fit together, and it doesn't get you to where you want to go. And that's the worst way to run, a multi-billion-dollar pool of money.
Right. Thank you. All right, let me move on then with Jay. I'm going to start with you on this question. Can you talk about how you or others in the field, broadly speaking, approach risk management with these public markets for the long-term investments?
Yeah, that's a good question. So putting aside any effort to define risk and risk management like holistically, that's probably a whole separate webinar. I would say, well, just talking about investment risk, right? First, I think we'll start with big picture and so first would be this idea of a diversified asset allocation, right? You have a lot of different asset classes as part of your plan. Hopefully, they're not all exactly correlated with each other, and so together they give you a return stream that's less volatile than anything individually. And that kind of, that smoother return stream helps you compound to a better result over the long horizon. Second, some of those asset classes that you have are designed to be defensive, right? They're not all kind of rip, high equity strategies or VC or something like that. Maybe they're long treasuries, or they're some kind of risk mitigating strategy. And so you have specific sleeves there that are designed to zig when the rest of the market is zagging. And so you can use those as funding sources to hopefully rebalance in the midst of a crisis and get your plan back on the correct footing. Lastly, for most externally managed plans or plans that use extra managers to run the money for you, you're relying on a lot of those strategies to appropriately position themselves. Hopefully they've been able to rotate to somewhat of a defensive position as they see fit, as they see appropriate for the market. And so all those pieces, from asset allocation all the way down to manager level decisions, hopefully they combine to give you some measure of risk management.
Perfect. Appreciate your insights there. Obviously, I'll open this up as well. If Oliver, Eileen have any additional comments, you are welcome to tap into this question as well. Okay. All right, I'll move on then to the next with Oliver here. I know as a researcher, I appreciate your perspectives in a very, very broad way. And you started to talk a bit in your last response about, it sounds like some of this can put strain on governments. This can be this is a major portion of a government's budget and a public pension plan. So as you're studying these state and local governments, share some perspective on the role that these public pension plans play in that broader financial health of the governments.
Yeah, there's sort of the sort of revenue and expenditure perspective, but personally, what I find quite fascinating is thinking about the balance sheet. So what are the assets and liabilities that the government has at any given point, right? And so really what I found quite interesting is, first of all, you can't consult a single resource to actually get a comprehensive picture on it. It's despite the tremendous economic size of state and local governments in the United States, just to give you ideas, like at about 30 million people employed by state and local governments, they account for about $5 trillion of public expenditures every single year. There's no, resource that you can easily consult and get a comprehensive picture on the financial state of governments, let alone on the components of the balance sheet. And so really, my research agenda over the last 7 years has been get comprehensive data on a wide variety of a broad sample of state and local governments, and first of all, just document what those balance sheets look like and what individual components play. And so let me just give you a few numbers from my original research. These are all numbers at the state level. So as of fiscal year 2022, states had approximately $1.2 trillion of debt obligations outstanding. That's like obligations that they issue into the municipal bond market. This can be, general obligations, or there can be revenue obligations. But really, when we start comparing now the size of pensions, it turns out that pensions on an actuarial basis are about 1.3 trillion at the state level. However, when we use what economists prefer, like a more like market valuation that takes into account the risk profile of those liabilities, we end up with a number that is closer to 4.3 trillion US dollars. That means like that unfunded pension liabilities are almost or more than 3 times larger than the debt obligations that states have outstanding in the municipal bond market. So that just gives you like a sense about what the size of these liabilities are. They're, pretty hard liabilities. It's very difficult to default on them. It's not like OPEB liabilities. So OPEB liabilities are essentially healthcare liabilities that state and local government gives to employees. They're, I think, a little softer in nature, where it's still unclear to what extent you can default on them. But for pensions, there was a very nice study, for instance, in Illinois, that showed that pensions are even more senior than, for instance, debt obligation. That means it's harder to default on pensions than on your bonds in the municipal bond market. So yeah, to sum that up, I think pensions are, just because of their size, a fundamental component to the financial state of state as well as local governments. At the state level, I think there's a little bit more homogeneity, but at the local level, there can be like tremendous liabilities that have to be funded. And to some extent, going now from sort of the balance sheet view to like the revenue view, there's obviously an interlinkage, because ultimately, like a preferred way to express pension costs is how many cents out of a dollar of payroll do you have to set aside to finance people's pensions? And just to give you a few numbers from California, that number on average was 22 cents in 2012 in California across all municipalities, and it has increased to about 45 cents as of the last fiscal year.
Well, lots of insights there. I think that points to the importance of some of the decision-making tactics that Eileen and Jay have brought up, in addition to even broader questions that you're researching, Oliver, on the structure of pension plans and where they could or should go from here. Any other comments here on the local government or state government side from Eileen or Jay?
I think the one thing I would add is, the numbers Oliver threw out are really big numbers when you think about how much of every dollar that's available is going towards funding the liabilities or the pension obligations of, the municipal or county or state fund. And that really does increase the pressure for the trustees of these funds to ensure that they're doing what they can to maximize the growth of assets. And luckily, the numbers support that most of the pension funding does come from the return generation of those assets, but that the pressure is just even higher to generate more returns as that per dollar commitment has increased.
Yeah. All right. Well, we'll let that sink in for a moment, and I'll move on to our next question here. I'll begin with Eileen for this one. I think your perspective could be interesting here on your 30-year career of consulting for institutional plan sponsors. So can you speak more to how you've seen strategic asset allocation evolve over that career?
Sure. So, as I mentioned at the outset, the pension funds, and I think Jay also emphasized this point, that these pension funds were a lot simpler in their structures, and emphasis on sort of the traditional public markets assets. And, at that point in time, let's call it in the last 30 years, that's been a period of a secular decline in bonds, right? Interest rates. So the exposure to bonds were pretty heavy, somewhere between 30 and 40%, because, bonds were returning 6, 7, even 8%. And then also there were no private market assets other than private real estate. So private equity was very nascent, and hedge funds were viewed as non-institutional. So there was no role for them. And now as we fast forward to today, there are, as I mentioned, pretty healthy allocations. 30 to 40% of the total fund now resides in private market exposures. In terms of the public market exposures, there used to be a, quote, country bias in funds, right? Mostly US stocks, maybe 10% in non-US. Well, today, most public pension funds have adopted capital market theory, in that their public equity exposures typically mirrors the benchmark or the capital market exposures in terms of US versus non-US. So that puts you roughly at a 55-45, let's call it, US, non-US split. So again, very different. What else has changed is the type of implementation approaches. So, a couple decades ago, it was predominantly actively managed public markets exposures. And then today, a lot of funds like, a lot of the state level and even the mega funds, I would say the majority of those US equities are in passive index funds, and either none or perhaps just a small cap would be invested in actively managed. And on the non-US side, not quite the predominance of passive. It's more, I would say, 70-30 or 75-25 active versus passive. But there is still some passive implementation. And so a lot of the focus, both in terms of strategic asset allocation and in the implementation, is on that private market side, which is very diverse. It's private equity, private credit, private debt. And then within those, you have mezz investing and distressed investing and secondary. So again, to emphasize the point that the sophistication level is very high now for public pension funds. You know, they actually mirror the endowment and foundation, the quote endowment model, right? So majority or approaching a majority potentially in public or private markets and alternatives, and then embracing more not only illiquidity rich but risk, but utilization of leverage. There are public pension plans that actually are levered 5, 10, 20% at the total fund level, and that was prohibited decades ago. So it's very, very different in terms of the strategies being implemented and the tools being utilized. And part of that is because there's so much better analytics to help evaluate and really understand the amount of illiquidity and leverage risk that funds are taking, so that they're not just taking them blindly, they're taking them intentionally because they expect to be rewarded for those risks.
That's great. I appreciate you taking us on that journey. That was I feel like I should have brought a bigger piece of paper to take notes because you've always spit some great facts. And again, in terms of our topic of understanding where we are as a pension funds and public pension funds specifically, that's some great information. So the recording will be available, which I'm sure we'll all go back to take a look at. So thank you for that, Eileen. I'm gonna kind of tag along to this question, and I may start with Jay here, and this one's a little off the wall, but we've had a couple questions come through from the audience about private markets. I know it's not your exact forte in terms of what you're required to do, but I do know you know a lot about it, and Eileen as well. So you just brought up, Eileen, that there's a lot more private markets investment. The question I want to ask though is just very briefly, how does a pension fund typically determine which managers they're going to invest with? And that can answer from a private or a public markets perspective, but just the management selection process. So Jay, I'll start with you if you can provide some insights on that process.
Sure. I'd say the manager selection process is usually pretty well defined at whatever pension fund, or I'll call it generally whatever allocation shop you go to, right? You usually start with some idea of this big funnel at top where you're kind of surveying the investable universe. And maybe even before that, you've identified a need, right? It could be, it could be your trustees or whatever stakeholders you have decided to change your asset allocation a little bit and created a new asset class. And so you're the guy on investment staff, guy or gal on investment staff, and you're watching your trustees get together, and you're thinking, oh gosh, they're creating this whole new thing that I'm going to have to structure and populate and select strategies for. Okay, let's see what they want. So if you go ahead and you carve out, a new private credit class, or emerging markets equity, small cap, something like that, right? Something that doesn't exist. And then on staff, we'll say, okay, well, let's learn about that asset class. What are the drivers there? What are the set of investment management firms that offer externally managed solutions there? You start off with that kind of broad universe, and you say, okay, what are the characteristics I'm looking for to fit that? Maybe what fits well with the rest of the strategies I have in that kind of broader space. What combinations am I looking for? And so that funnel, it gets whittled down through some combination of analytical, quantitative type work. You get to a point where you want to start researching the teams of people and the actual people behind the strategy. So the portfolio management team, the research analysts, you start kind of digging into their biographies, how they work together, their tenure there. Maybe you cross-reference them against prior places they've worked. You're talking about firm characteristics, people. There's a couple other P's, I think, in there somewhere. It's in the CFA curriculum. And ultimately, though, whatever your process is, you get down to a handful of names, right? And maybe a handful of shortlisted names that not to say you're indifferent between those. You have a favorite there, but depending on your governance model, you may not have the ultimate decision-making authority, right? You might have to go in front of your board or investment committee and say, hey, these are the shortlisted candidates. And, I'd like to talk about them in this order. You have your consultant come in and kind of provide an opinion on those. And then maybe your IC selects, maybe your board selects, maybe you as staff, you have discretion delegated to you, and you get to make that decision. But, again, generally broad to narrow. You're thinking about how that puzzle piece fits in with the rest of the plan. Then you make a choice.
Great. Thank you. No, I appreciate that to try to answer some of the questions that have rolled in so far. Oliver, let me turn to you. I'm gonna give you 2 questions and you can pick and choose to answer both or take one of them. But since you've already kind of probably touched on some of them, but what trends are you noticing in terms of how state and local governments are managing the obligations that you just shared some relatively massive numbers to? And the second one, and this may be part of the answer, but this idea of defined benefit versus defined contribution trade-offs among public pension plans.
Yeah, let me maybe take the first question first, and which also connects a little bit to what Eileen said. Eileen mentioned that there's a secular decline in interest rates pretty much since the early 1980s. Obviously, it's been somewhat stagnant over the last 10 years or last 15 years by now. And so that is also represented in the discount rate that pension funds assume. So in 2014, the average discount rate was close to 7.5%. And then the end of the fiscal year 2020, that dropped to 6.9%. It seems like a small drop, but actually, if you have like billions of pension liabilities outstanding, that actually makes a big difference in terms of their valuation, but also makes a big difference in terms of what is the ongoing pension costs for state and local governments across the country. I mean, obviously, among economists, I would say that drop was pretty much appreciated. One should, however, say that the pension liabilities are inherently, as I mentioned, a hard liability and relatively unrelated to the business cycle. In fact, economists argue that these risk profiles should be discounted to something closer to a risk-free rate, which currently stands at about 4%. So there's still like quite a discrepancy between these two things, between the assumed discount rate as well as the risk-appropriate discount rate. And so actuaries actually sort of acknowledge that, and the actuarial standards of practice that were revised last year actually require disclosure under a risk-free discount rate nowadays. So there's some movement towards that direction, but I think that's also like a trend that probably we're going to see continued over the next 10 years. Another question, and that's more sort of on the policy side that I want to bring up, is certainly, I mentioned there's about 86% of public employees are enrolled in a DB plan. And so here, what we see in these DB plans is certainly a reduction in benefits. So just one example that is sort of very big in terms of magnitude, that was PEPRA. That's a pension legislation in California in 2014, which is essentially adjusted the benefit formulas. That means like what is sort of the fraction of the benefit that you obtain as a fraction of salary. And so for most employees, so I should say that's only applicable to new employees, but for most employees that meant essentially a reduction in benefits relative to the benefit formulas that were valid before PEPRA. And so these type of reforms you see actually across a lot of jurisdictions. Since over the last 10 years, there was a little bit of a pushback maybe in the last 2 years. As I mentioned, the funding had improved already at that point. So unions felt empowered that they maybe want to push back a little bit on the benefit side and actually negotiate higher benefits. But I would say the overarching trend over the last 10 years was definitely a reduction in pension benefits. sort of more far-reaching reforms are still rare. So like one of the reforms that I'm aware of is, for instance, in North Dakota last year, which closed the DB plan and enrolled all future employees in a DC style plan. But once again, these are sort of if you think about the reduction in benefits as sort of incremental adjustments, closing an entire DB plan and enrolling future employees in DC plans is really like almost a radical adjustment process. So that's rare, but it happens. And I think it happens for good reasons. So I think, Eileen, you mentioned, or maybe it was Jay, you mentioned that DB plans have actually very long vesting schedules. So there was a recent research paper by the Equitable Institute that showed the average vesting period for US public pension plans is 6.9 years. That means essentially that an employee has to stay with their employer for 6.9 years to become eligible for full pension benefits once they retire. And surprisingly, or maybe not surprisingly, only about 40% of public employees that enter their job actually reach these vesting threshold. So that means like these DB plans with, as I said, they have a lot of other sort of contractual characteristics which become really quite important, essentially punish mobility, because it's really hard to move from one employer to another, sometimes within states, but certainly if you cross state lines. And that's just like one current contractual characteristic. There are some other that are very sort of inherent to DB plans. That's so for instance, the fixed division between take-home pay and retirement benefits, or the limited portability. And so if we sort of zoom out and think about the big picture, well, the workforce is obviously evolving. Millennials and Giesecke enters the workforce, and it really sort of should raise the question whether we should maybe reconsider the retirement plan options that the state and local government provide to make it attractive to join public service. Because there are some surveys, and they seem to indicate that millennials as well as Gen Z have a greater mobility across employers during their careers.
Great. Thanks for answering both of those questions. Certainly appreciate it. I see we've had upwards of 20 questions submitted to this panel, and I think we've at least touched on most of them through the questions already asked, but there's certain ones we're not going to be able to get to in our short webinar, but nonetheless, you all have given a great overview of understanding public pension funds and what the landscape looks like. So I guess I'll leave probably with this final question, and that is, as we look to the future, how do you see these public pension plans evolving, or how does someone, again, our listeners seem very engaged, how does someone stay up on these evolving trends, and what recommendations do you have to keep up with all this? And I'll start with Jay here on this one.
Oh, let's see. That was an interesting question. How are public pensions going to change going forward? Part of it depends on all of the topics that Oliver touched on, kind of the affordability for the sponsor on a continuing basis for these essentially public employee benefits, right? You think about the time horizons we're talking about. You could have a public employee hired today out of school. Maybe they're working for 20, 30 years, and then they go and retire, and then they have a 20, 30-year retirement, right? So the liabilities you're stepping into today in running a pension plan may not end for 60 years. And that's on a rolling basis. And so you have to design some kind of structure that's survivable over, almost the next century, really, because these legal obligations are very hard to get out of, right? And you can check into the history of public pension reform here in California with either PEPRA or some of the lawsuits in the Bay Area here. It gets pretty contentious. So how are public pensions going to change? Gosh, man. I think the
Fair enough.
investment side.
How about staying up to date on some of the evolving trends? What are some of the things you do to keep up with what's going on in the landscape?
Yeah, I think you're always reading the news, kind of staying abreast of whatever public resources you have. The issues that affect public pension plan portfolios are not dissimilar to kind of general portfolio management problems overall, once you adjust for, say, liquidity and kind of other conditions, time horizon. But kind of the structure of public pensions as an organization, that's kind of a hard one to follow. You really have to kind of tune into a board meeting once in a while and try and stay awake for those, I think. But there are different consulting resources out there that you can follow. If you're a student, the CFA curriculum is pretty good to kind of get you prepped for all those topics that you will encounter in public pension land.
Great. All right, Oliver, what about you? Do you have any final thoughts on evolving the next decade of pension plans, and or how do you stay up to date on evolving trends or recommend our audience to do so?
Yeah, I mean, I had several discussions with state legislators recently, and I think one sort of reoccurring theme is hiring and retention of public employees. And obviously, pensions have historically always been seen as sort of one major contributor why people would join public service. And I think this view has to be reevaluated, potentially updated, given that, the new generation of people that join the workforce may not look like the previous generation. They may have different preferences. In fact, I run a big survey to get a sense about what those preferences might be. And so, there's a bit of a tension, a political tension, because those people that negotiate pension benefits on behalf of employees tend to be the most senior employees. And there might be a little bit of a disconnect between what senior employees want and what people want that, join the workforce. And so should, I think, spark a bigger discussion, and hopefully there will be not necessarily an entire sort of closing of DB plans, but maybe there might be a broader options that are being offered to the workforce where people can self-select into the plans, which could be beneficial for obviously employees, but it, as Jay mentioned, I think it could be also beneficial for the financial sustainability of governments across the United States. I guess another thought on how we can stay updated. I think, I hope there will be going forward a drive to higher transparency in that sector, because right now, all these information might be disclosed, but they're really difficult to access. And so actually, our team here at Stanford spends tremendous resources to collect all those reports and put them into a database, and we make a dashboard available which you can access at publicpension.stanford.edu. You get a sense about the liabilities, the discount rates, the pension costs as a percentage of payroll. Obviously, this is only offers sort of a view into the past, but still some of the trends are really, really interesting, and sometimes the past is the best guidance for the future.
Great, thank you. Yeah, so we'll have to take a look at your survey and hear about those results, and then check out the data at a big aggregate level across, I believe, the U.S. Rather than trying to hunt through each individual county, city, or state pension fund. And Eileen, let me wrap up with you. How do you see public pension funds evolving in the next decade, and ways for our audience to stay up to date on evolving trends?
So, I mean, there's two sides to that question, and I think both Jay and Oliver really focused on the liability side, so I won't add any more there. But on the asset side, I think the trends will continue to the extent the plans remain defined benefit plans. And I think there's a lot of argument for that, in particular because plans typically at the state level are comprised, a lot of the big population of those plans are teachers, and teachers do tend to stay in more local and do tend to have long tenure with these funds. So if you presume that the defined benefit public plan option will exist, let's say another 10, 15 years, by and large, then I think the trend will be that continued evolution towards embracing more esoteric, if you will. So more continuing to have private markets, investments, and we didn't touch on it, but I know that there are other types of assets. There's digital assets, there's royalties, there's other types of investment options that are being increasingly evaluated and utilized to expand that investment universe in order to continue to retain high returns or attain high returns. And I think focusing on costs, because we know costs do meaningfully reduce investment returns. So I think the genie is out of the bottle in that there will continue to be greater utilization of passive investments. And there is also a trend, particularly again in larger state level funds, towards bringing more asset management in-house. So as another way of both reducing costs and providing career paths for the skilled investment professionals that these funds want to and need to retain in order to continue to implement the asset allocation in a way that will ultimately achieve the board's objectives.
Fantastic. Thank you all. I can't say thank you enough to each of you. That was very insightful. Lots to think about. It looks like we should probably do another few of these webinars to follow up on all the topics that you brought up. I'll say a big thank you to the CFA Society of SF and Tanya for helping organize this webinar. And final, Jay Kwon, thank you very much. Eileen Neill, thank you very much. And Dr. Oliver Giesecke, thank you very much for being here and for your time. And thank you to the audience for joining. The recording will be available in a couple of weeks to follow up with all the questions you may have, and hopefully many of them were already answered. So take care.
Thank you.